Welcome to this deep dive. Today we're looking into Eni's 2024 performance. We'll be using their latest annual report to uh, really unpack their business segments, financials, and importantly, their future strategy.
Exactly. And the goal here is to give you the key insights without you having to wade through the whole report. Think of it as, well, a shortcut to understanding this major energy player.
A very diverse player too, right? From traditional E&P all the way to renewables.
Absolutely. They cover a huge spectrum. So our mission today is basically to pull out the most important nuggets from that report, make sense of them, and give you a clear picture of where Eni stands and where it's heading.
Okay, let's jump right in. Exploration and production E&P. Still a massive part of their business, I assume.
Oh, definitely. It's foundational. They posted a pretty significant pro forma adjusted EBIT of €13 for 2024 in E&P.
13 billion. And what's driving that? Production growth,
Yeah,
cost control.
both actually. Their hydrocarbon production was up by 3%, hitting an average of 1.707 million barrels of oil equivalent per day. That's partly organic growth, getting more out of existing areas, and partly the full integration of Neptune Energy, which they acquired.
Right, Neptune. And where's this organic growth coming from mainly?
Key areas where Côte d'Ivoire, the Baleine project, is ramping up nicely there. Also Congo, Mozambique, Mexico, and Libya too.
Interesting mix. And was it more oil or gas driving that production increase?
It was reasonably balanced, actually. Liquids production saw a 2% bump, up to 784,000 barrels a day. But natural gas had, well, slightly stronger growth, up 5% to over 4,800 million cubic feet per day. Gas is clearly still very important.
Okay, so growth in some areas, but I also saw mentions of divestments, selling off assets.
Yeah, that's what they term portfolio high grading. It's about focus. They sold off some oil properties in Nigeria, their assets in Alaska, Nikichuk and Ugaruk, and some holdings in Congo, basically shedding things that aren't core to their future plans.
Streamlining makes sense. And they're also turning undeveloped reserves into developed ones. I saw a figure for that.
That's right. They matured 128 million barrels of oil equivalent from proved undeveloped, or PUDs, to proved developed reserves. That means they're closer to actually producing that oil and gas.
And that takes investment, obviously.
A lot of investment. Around 10.3 billion in capital expenditure in 2024 was funneled into progressing these kinds of development projects. It happened mainly in places like Côte d'Ivoire, Angola, Kazakhstan, and Italy.
Any major new finds or project milestones we should know about?
Definitely. The Kalau discovery off the coast of Côte d'Ivoire looks promising. And sticking with Côte d'Ivoire, the Baleine field hit some key milestones. Phase 2 is done, and Phase 3 is planned to take it up to 150,000 barrels of oil and 210 million cubic feet of gas per day.
That's substantial. Anything else?
They also greenlit the Bonga North project in Nigeria. That's a final investment decision, so that project is moving forward to boost production there.
Sounds positive overall for E&P, but there are always challenges, right?
Yeah.
Did the report mention any specific headwinds?
It did. Geopolitics is always a factor, particularly noted in Libya. Then there are financial aspects like receivables from PDVSA in Venezuela, potential credit risks linked to the Nigeria divestment, and some funding issues with state-owned partners in Egypt. These are things they have to navigate.
Right, the operating environment is complex. Okay, let's shift to their global gas and LNG portfolio, GGP. How's that side looking?
Pretty solid. GGT brought in 1.1 billion in pro forma adjusted EBIT. Their gas sales were substantial too, nearly 51 billion cubic meters. It shows the business model is working well.
And the strategy there, is it just about selling gas or is there more to it?
It's more sophisticated than just selling. They focus on diversifying where they get their gas, and LNG from that helps with security of supply.
Yeah.
They also use hedging quite actively to manage price risks. Yeah, and they're constantly optimizing their pipelines, terminals, that sort of thing. Plus, integrating their own upstream gas production into the GGP framework helps maximize value. It's quite integrated.
Got it. Now let's talk about Plenitude and Enilive. These seem to be their big bets on the energy transition, these sort of satellite businesses.
They really are central to that transition story. And interestingly, both hit their profitability targets for the year, around 1 billion each in pro forma adjusted EBITDA. That's earnings before interest, taxes, depreciation, and amortization.
$1 billion each, despite what the report called an unfavorable environment. That's impressive. Let's break them down. Plenitude first, that's renewables.
Yes, Plenitude is focused on renewables and retail energy. Their installed renewable capacity jumped significantly, up 37% to 4.1 gigawatts compared to 2023.
Almost 40% growth. Wow.
Yeah, and they're making targeted moves like acquiring solar capacity in the US from EDPR and partnering on offshore wind in Spain. It's not just growth for growth's sake.
And didn't they get external investment into Plenitude?
They did. Energy Infrastructure Partners, EIP, took a 10% stake for about multiple.8 billion. That's a big external validation of their strategy and, helps unlock the value in that satellite model.
Okay, and Enalive. That's the biofuels and sustainable mobility arm.
Correct. Enalive is all about biorefining and greener transport solutions. They're actually building 3 new biorefineries right now.
3. Where?
One's a conversion project in Livorno, Italy. Then there's a joint venture with LG Chem in South Korea and another JV in Malaysia, so expanding their footprint significantly.
And similar to Plenitude, Enalive also attracted a major investor.
A huge one. KKR came in, initially taking a 25% stake for 2.9 billion, and then just early this year in Feb 2025, they actually upped that stake to 30%, putting in another 0.6 billion.
That's a massive signal from a major investor like KKR.
Absolutely. It really underscores the perceived growth potential there and, again, reinforces that satellite strategy of building value in these distinct transition-focused units. The JV with LG Chem in Korea was also formally set up.
Okay, one more segment. Versalis, their chemicals business. Sounds
Yeah.
like it's undergoing a bit of a shakeout.
Yeah, Versalis launched a pretty major restructuring and transformation plan in 2024. The focus is shifting towards the energy transition, the circular economy, and more specialized, higher value products.
So less basic chemicals, more specialized stuff.
Exactly. They're leveraging their tech know-how, but moving up the value chain. There's a new investment plan for these high-value platforms while they restructure their exposure to the more commoditized basic chemicals. It's a big strategic shift.
Right, aligning the whole company, it seems. Okay, that covers the segments. Let's get into the overall financial picture for 2024. You mentioned the E&P EBIT, but what was the group level adjusted EBIT?
The group pro forma adjusted EBIT was 14.3 billion. Now that is down about 20% from 2023.
20% down. Why the drop?
Mainly external factors, things outside their direct control, primarily lower energy prices, oil, and especially gas compared to the highs of 2023, and also weaker refining margins hurt them. Those pro forma adjusted figures try to smooth out one-offs to show the underlying trend.
Got it. And the standard reported operating profit?
That was 5.238 billion, which is also down from 8.257 billion the year before. But if you look at the adjusted operating profit from their subsidiaries, that was higher at 10.348 billion. The adjustments, can make a difference in how you interpret the core performance.
So profitability took a hit from prices, but the underlying operations still generated significant earnings. What about cash flow? Always crucial.
Cash flow from operations was still very strong, 13.092 billion, again, lower than 2023's 15.1 billion, but still a huge amount of cash being generated.
And CapEx, did they pull back spending?
A bit, yeah. Capital expenditure was 8.485 billion, down from 9.2 billion, mostly directed at those upstream projects and renewables we talked about.
So lower cash from operations, but also lower CapEx.
Mm.
How did free cash flow end up?
Interestingly, free cash flow, which is basically operating cash flow minus CapEx, actually went up slightly. It was 3.806 billion in 2024 compared to 3.560 billion in 2023.
Huh. So managing spending effectively helped cushion the blow from lower operating cash.
Seems that way. Disciplined capital allocation can really make a difference to the free cash figure, which investors watch closely.
Okay, what about the balance sheet? Net levels.
Net borrowings, before you account for lease liabilities, did increase. They ended 2024 at 12.175 billion, up from around 10.9 billion at the end of 2023.
So leverage ticked up a bit.
Presumably, yes. They mentioned leverage the ratio of debt to equity as a key metric they monitor for balance sheet strength, though the exact ratio wasn't stated in the summary we're looking at. But on the plus side, shareholders' equity itself grew, reaching 54.7 billion.
Okay, so wrapping up the financials. The key story is solid operational performance, especially in E&P and the satellite businesses, but overall results were pulled down by lower commodity prices compared to an exceptional 2023. Is that fair?
That's a very fair summary. Production growth and cost control in E&P helped. GGP was stable. Plenitude and Enalive hit their targets. And those big investments from KKR and EIP were major positives. But yeah, the weaker price environment was the main drag.
Right. Now, for many listeners, the crucial part is shareholder value. What's Eni doing to return cash to investors? Dividends.
Yes, dividends are a core part. For the 2024 financial year, they're distributing €1 per share, and they paid out in four chunks throughout the year: September 24, November 24, March 25, and May 25. Provides regular income.
€1 per share, paid quarterly. And buybacks. Are they buying back their own stock?
They are, quite significantly. They have authorization to buy back up to 328 million shares by the end of April 2025. That's a potential outlay of up to $3.5 billion.
$3.5 billion. That's serious. Is that all just to boost the share price?
The vast majority, yes. Up to 321.6 million shares are earmarked specifically for returning cash to shareholders. A small slice, about 6.4 million shares, is for their employee stock plan. They also have the okay to cancel most of the shares they buy back.
And how much had they already bought back by the end of last year?
By December 31st, 2024, they'd already repurchased nearly 118 million shares under this program, spending about $1.64 billion. So they're actively executing on that plan.
Okay, dividends and substantial buybacks. Seems like a clear commitment to shareholder returns. So, looking ahead now, putting it all together, what's the big picture assessment? How is Eni positioned?
I think that satellite model is really key to understanding their strategy moving forward. They're trying to build these distinct, financially independent businesses like Plenitude and Inalive, focused squarely on the energy transition and attracting external capital to fuel their growth.
While also transforming the older businesses.
Exactly, like the changes happening at Versalis, shifting towards circularity and specialty chemicals. It's about evolving the whole portfolio, and they're backing it with money planning over $5 billion a year, average capex for new projects, and ramping up production.
And they have that net zero by 2050 target hanging over everything as well.
Right. That commitment shapes a lot of these decisions, driving investment into transition businesses. But of course, they still operate in a risky world.
What kind of risks stand out?
Their report highlights the usual suspects for an energy company. Commodity price swings are always a big one. Geopolitical instability in places like Libya or Venezuela. Credit risks with counterparties. And frankly, the uncertainty around the pace and nature of the energy transition itself is a major risk factor they have to manage.
So it's a balancing act then. Managing the legacy business while building the new, lower carbon one, all while keeping shareholders happy.
That's the core challenge, isn't it? Optimizing the traditional energy side, investing heavily in the transition, managing risks, and delivering those returns through dividends and buybacks. It's a complex navigation.
Well, this has been incredibly insightful. We've covered the performance across E&P, GGP, Plenitude, Inalive, Versalis, dug into the key financials, looked at shareholder returns, all based on their 2024 annual report. Hopefully this gives you, our listeners, a much clearer picture of Eni today.
Yes, hopefully a useful distillation of a lot of information. It really shows how one of the traditional energy giants is tackling this massive shift in the energy landscape.
Definitely. So here's a final thought to leave you with. How effective will this satellite strategy ultimately be for Eni's decarbonization? Does creating separate entities like Plenitude and Inalive, attracting outside investment, actually accelerate the transition for the whole group? Or could it risk creating silos, potentially slowing down the integration needed for a truly deep transformation? Something to mull over.
A great question. The interplay between those satellites and the core business will be fascinating to watch.
Indeed. Thanks for joining us for this deep dive.